And that would be Miss Tina Adams. Tina is an accredited financial counselor and mortgage consultant with an emphasis in credit repair and management. She's been in the industry, personal finance for 7 years, and she has a passion for helping home buyers move through the mortgage lending process with confidence and a peace of mind. And so, with that, we're going to turn it over to Miss Tina to talk about the things you need in order to go and apply for a mortgage and how to get your credit and all those finances in shape. Miss Tina.
Thank you, Al. I appreciate it. Good afternoon, everyone. Can you hear me okay?
We can hear you.
Okay, great. So thank you, Al, for putting this wonderful seminar on. This is very much needed. Like you were saying earlier, that creating assets is very important in our community, and this is one of the best ways to do it is to go ahead and purchase your home, and so that becomes an asset that you're able to make moves from. And so I'm going to be talking about the process of getting your mortgage loan started. And so, like Al was saying earlier, and that was amazing, Chris. I hope everybody was listening because Chris is very thorough. He has done my inspections and he does an amazing job. So I just want to say that first and foremost, even before you put an offer on a home, you definitely want to call Chris. But I'm going to talk about that a little bit. But the first thing you want to do is find a mortgage lender. It's good to know who you want your real estate agent to be. But even when you go to that real estate agent, the real estate agent is going to send you to a mortgage lender. And the reason why is because you want to go ahead and get a pre-qualification letter that's going to tell your realtor where to go and what to do. Because that pre-qualification letter is going to let them know what type of loan program you're going with, because there's several different loan programs. There's conventional, there's FHA, VA, rural development, and so on and so forth. So they want to know, even that tells them where to go and what they're going to be looking for as far as doing your negotiation and finding your home. The second thing they're going to need from that pre-qualification letter is how much you are approved for. So before they start looking for homes for you, they want to know what your price range and what your affordability is. So your mortgage lender, when they hand you that pre-qualification letter, that's giving you an indication of the max amount that you can borrow. Now, one thing about that max amount is it can be up to you as well. So you can tell your mortgage lender, hey, I don't want to go over $900 a month for a payment. So then they can fix your max amount to show the realtor how much you're willing to pay per month, or how much you are able to based on your budget. Because of course your realtor doesn't want to find something for you that you're going to be uncomfortable making payments to. But this is what you want to do, or know, going to a mortgage lender. Do you have 2 years of consistent work history? So you want to be able to show a consistent flow of income coming into your household for at least the last 2 years. And with that, it needs to be a career or occupation. It needs to stay consistent. So you don't want to go from being a plumber and now all of a sudden you're a mechanic. And so that's not consistent. So when the mortgage lender sees that, they're going to need an additional year in that. Say, for instance, yet last year you were a plumber. This year you went to being a mechanic. So they may ask you to go another year as a mechanic because you switched it up so much. However, you can switch jobs and still be in the same occupation. So that is a different thing. So if you go from being a mechanic at AutoZone and then you go and decide to work for a car dealership, you're still in the same occupation, so that those 2 years would count. And so you want to have a consistent 2 years of work history. Your credit score needs to be 620 or above. And that is to be able to take advantage of these pretty good interest rates out here. The closer to 700, the better. Now, there are some mortgage companies that take a 580, but you have to keep in mind that that is going to also cause your interest rate to be a little bit or a lot bit higher than it would be with a higher credit score. And if you don't have a credit score, say for instance, you are a person that has been living without credit, you pay everything with cash, then there is a way that the mortgage lender may be able to get you approved through non-traditional credit. And non-traditional credit is if you have been paying your utilities on time, your rent on time, and different things like that, then they can build a credit score for you. And that'll be going through their manual underwriting. So when they go through manual underwriting, you may have to, a lot of times you're going to have to come to the table with your own down payment, because their down payment assistance programs that are out there right now through FHA, they don't accept manual underwriting. So please keep in mind that if you don't have a credit score and you're using non-traditional credit, that you may have to use your own money for down payment. DTI. This is one of the most important things. So some people think that, hey, as long as my credit score is good, I should be able to get approved, and that's not always the case. So we have to make sure that your income and covers the debt that you already have, plus the cost of the loan that you're getting ready to occur. So if your DTI is over 45%, that may be an indicator that you may be heading towards being overextended. So with the FHA loan, it can go up to 50%. So it just depends on what loan program you're going with, but whatever mortgage lender you're going with, they're going to pick the loan program that makes the most sense for you and your financial situation. But just keep in mind, if you have a lot of debt, you may have to, your mortgage lender may tell you that you have to pay some things down, but don't start paying on anything before your mortgage lender tells you to, because you may pay on the wrong debt and they come back and say, well, I didn't need you to pay that off. I would have rather you had taken that money and paid this off. So you want to make sure that you wait on the mortgage lender. If they tell you that your DTI is a little bit too high, they can usually tell you what's doing it. So if you're, say for instance, just for an example, if your car note is super high, but your credit score has risen since the last time you got that car note, you may be able to refinance, and now that payment is much lower, and then as a result it will lower your DTI. So those are just the main three things: 2 years of consistent work history, your credit score, and your DTI. And so when you apply, you'll just have those things in your mind. A way to calculate the DTI is you take your total debt, everything that's reported on your credit. Now, we're not talking about your light bill, water bill, groceries and gas. We're talking about your credit cards, loans, and other things that might be reported into your credit. You will total those things up, divide it by your gross income, and multiply it by 100, and that's going to give you your DTI. So you total your debt, divide it by your gross income, multiplied by 100. That's going to give you your DTI. And so that is going to, let's say everything like that checks out, you're looking good. They're going to give you a pre-qualification letter, and it's going to tell the realtor where to go, what to do, how much you are approved for. Realtor has found a house, you guys have put an offer in, it has been accepted. That is when you come back to the mortgage lender and give them your contract. The mortgage lender can't do anything or move on the loan until they have an active contract. And after that contract, that's when they're going to start asking for the documents to prove what you told them on the front end. So if you told me you made $50,000 a year, that you work at the school, you're a teacher, or, you know, all those things, we're just going to have to check your verification of employment. Now we're going to have to check, we need your paycheck stubs. We're going to check everything to make sure that everything checks out. And then that's basically loan processing. And after everything checks out, then that's when it moves on to the underwriter. The underwriter is what's going to make that final decision on whether that's a good risk or a bad risk. So each bank they want to give loans, but in order for the bank to make sure they don't lose out on a lot of money giving out loans, they have the underwriting department. Some people are afraid of the underwriting department. The underwriters, sometimes they're like the big bad wolves, but what they're trying to do is protect the bank. So what they're doing is just making sure that everything lines up with your loan. And if you have consistent work history, your credit score is good, and your DTI is good, usually the underwriting department is not going to be that tough. And so just work with your mortgage lender when they ask you for the documents that is being requested from the underwriters. You want to get those back to them in a timely manner. So there's been times where I've been waiting on someone to get me their paycheck stubs. And then they come back and say, hey, what's taking so long with the loan? I'm like, I'm still waiting on you. So you have to definitely operate and cooperate as fast as possible with your mortgage lender. And that's going to determine how long it takes.